Hello everybody and welcome to an episode on my channel. So today we're going to be looking at one of my favorite dividend growth stocks, that is CP Rail. Now if you've been following my channel for a while, you should know that I'm very bullish on the railroad sector in general. The railroad sector actually makes up about 11% of my total YouTube dividend growth portfolio, and CP Rail actually makes up about 5% or 5.5% of my total dividend growth portfolio. Now I've done videos on the past on the entire railroad sector, and I'll leave a link for those videos in the description below and in the top right hand corner. But today we're going to be looking at CP Rail specifically. So let's go and look at some of their most recent Investor Day presentation slides. So this slide right here is speaking to the railroad industry as a whole, and it does some comparisons with trucking, but we're going to be looking at this side first. So basically what this slide is telling us is that railroads are very sustainable, or what they call sustainably driven. So they're speaking to the amount of GHG emissions, and that stands for greenhouse gas emissions. So railroads actually account for less than 1% of the GHG emissions in terms of the industrial sector. So they are very, very sustainable with respect to total GHG emissions. Now, this section of the slide right here is speaking to a comparison of transportation by rail compared to trucking, and stating that transportation by rail is one of the most economical and environmentally responsible methods, like we saw here, speaking to those GHG emissions. But the rail versus trucking, so again, a single unit train keeps more than 300 trucks off of public roads. So I just want you to kind of think about that. These trains operate on the rails, and they are out of the way of public transportation or public roads, and they haul such large amounts that they're able to take more than 300 trucks or truck hauls off of the road by that single train carrying that freight. Now, the trains or the railways are 4 times more fuel efficient than trucks, and they emit less than 75% of these GHG or greenhouse gas emissions. So again, very, very good for the environment and very economical here. All right, so this is CP Rail's actual rail line, and I really like this rail line because it details the various tracks, and it actually shows you how strong their moat is. So it goes through like the largest capital cities here when you're moving from east here to west over there, across Canada, and then also down through various cities in the US and all the way through to Mexico. So it's hitting a lot of key ports, key capital cities here in all three of these countries. So when you look at their commentary here, they state that there's 3 country connectivity, again speaking to Canada, the US, and Mexico now, at 20,000 track miles, 30 plus ports and 30 plus auto facilities, 200 plus transloads, and 90 plus short lines, unique strategic land assets. So when you look at how their capability of this rail line and where it goes to, passes through Vancouver, Edmonton, Calgary, Regina, Winnipeg, Minneapolis, got Thunder Bay, Toronto, Windsor, Buffalo. Again, all of the major cities here in Canada. You got Milwaukee, Detroit, New York, Kansas City, St. Louis, Dallas. It makes its way all the way down through the US into Mexico and hitting Mexico City, as well as some other key points here in Mexico. So this is such a unique asset because they are really the only railroad, or the only class 1 railroad, that has this capability to span into 3 countries. Now, a lot of them have this cross capability between Canada and the US, but no one has the 3 country capability or connectivity that CP Rail has after they made that Kansas or KSU acquisition. All right, so I really like this slide because now again we're looking at a little bit at the financials, but capital investment. Railroads, again, they require substantial capital investment. You got to maintain those rail lines, sorry. It's very, very capital intensive, costs a lot of money. You got to spend money on freight cars, keeping things safe. Again, it is a very capital intensive industry, but the great thing about it is if you are able to have substantial capital allocation strategy in place and you watch your dollars and how you spend them, you can actually make great returns. Now, here they're looking at their capital investment and they're prioritizing safety, service reliability, and growth. So over 50% of capital investments are allocated towards safety and replacement initiatives to ensure their network remains safe and efficient. So I really like this. Again, if you've been following the news over the past couple of years, there's been a bunch of train derailments. One of my other holdings, NSC or Norfolk Southern Railway, actually had a couple derailings. Those were very, very tragic, very, very publicized. So again, keeping these rails safe should actually be one of their top priorities, because it not only keeps people safe, but it also reduces the amount of future capital expenditure, because you've invested so heavily in the first place by making those railways safe and efficient. Now, strong pipeline of high project returns, disciplined approach to capital planning. So I like to hear this, a very disciplined approach. And they reinvest in the business to enhance safety and enable growth. So their key investments in safety and capacity were made ahead of the KSU merger, priming the combined network for growth. So this is really great. They were thinking ahead. They made these investments while they were just CP, not CPKC, before the merger. And now they are going to reap the rewards of making those investments. So very, very excited for that. Now their capital expenditures here. So when you look at, they made a nice graph here, but for CPKC combined, 2022, roughly 2.2 billion in that annual fiscal year of capital expenditures. 2023, 2.7 billion, but they're saying it's going to stay in this 2.6 to 2.8 billion capital expenditure line moving forward. So again, that's from 2024 until 2028. So I like that. It's not going to require a huge amount of investment here. It's going to be relatively similar or relatively smaller, because they made all of those initial investments while they were CP, and they had a feeling that they were going to get this merger approved. And once that came through, all of these initial investments or capital expenditures would come to fruition in terms of great returns. All right, so their balance sheet. Now, one of the knocks on railroads, and I actually do agree, is they are very, very levered businesses. Like I said, they have to spend a lot of money to maintain their businesses, and they do so by taking on a lot of debt. Now, the other portion or the other side of this is a lot of these railways actually use a lot of this leverage or debt to buy back shares, thereby rewarding shareholders by making them larger equity holders in the company. But that does come with the negative connotation of having a lot of debt. Now, I like to invest in companies that are not highly indebted. I like them to have strong balance sheets, but that's just the way the railway industry has been operating over the past years. So what I really like here is they're showing a commitment to shoring up or strengthening their balance sheet. So they're saying that they basically want to target a 2.5 times adjusted EBITDA to net debt. Now let's look at how they've had the leverage in the past. So they were sitting at a 4 times in 2021. 2022, they did a nice drop to 3.8 times. So by Q2 2023 is down to 3.6. So they're on their way to steadily ladder this debt down with that goal of hitting 2.5 times of leverage. So again, that's great to hear in my opinion. I want them to pay down that debt. Keeping debt at a sustainable level just means that they will spend less and less on future interest payments and have more cash flow in the future to reward shareholders, as opposed to paying them out right now. Now, they state they're committed to a strong investment grade credit rating. So CP completed issuance of debt to fund cash for consideration of that acquisition of KCS in November 2021. Debt was issued to optimize their ability to delever while also locking in attractive long-term financing rates. So what I really like here is that they mitigated this interest rate risk. Again, speaking to if you had a variable rate and the rate jumped up, you would have higher interest payments, but they did lock in fixed interest on 100% of that term debt. Now, what I really like is that they also paid, cash, like they said, with this debt for the acquisition. And we're looking at their share count. They did issue some stock, but in my opinion, it was actually a decently proportionate deal that they made. Now, significant liquidity available over this deleveraging period via US $2.2 billion undrawn committed credit facility. So again, speaking to, they could, if they needed to, withdraw another $2.2 billion, another $1.5 billion in the commercial paper program, and pausing of share repurchases. So again, they can do any of these things if they do need more money or more liquidity. In my opinion, they're probably not going to. They're probably just going to keep using their free cash flow and leave these undrawn. but I might see a slight decrease in the amount of share repurchases that they've done. And again, I expect that. I would rather actually prefer that and have them pay down the debt a little bit faster if they could. So they're going to continue to repay this debt on a path back to their target leverage of 2.5 times adjusted combined net debt to their adjusted EBITDA ratio. So let's go and look at Stock Unlock. So I really like this platform. I actually just uploaded my portfolio to it. It's through Daniel Pronk. If you haven't seen his channel, I believe it's at Daniel Pronk on YouTube. Check it out. Great, great portfolio he has, and a great platform. He actually just did a video on CP Rail, so check that out as well. Very, very informative. I kind of parallel or share the same thoughts that he has, and I've been investing in CP Rail for a while. So again, I encourage you to check out his video there too. So if you go and look at my portfolio here, you can see it has a total US dollar value of roughly $39,000. And as you can see, I'm up roughly 13.37%, which is roughly 42 or 4,300 US dollars. And I do have some cash here as well. Now, if you look at CP Rail, like I said, makes up 5.5% of my total YouTube dividend growth portfolio. So let's scroll down and let's look at CP Rail. All right, so CP Rail here, again, as you can see, I have roughly 29.8184 shares, makes up about 2,100 US dollars. I'm up about 4.59% here, which is about $94. And let's go and look at CP Rail in detail. All right, so we've popped up CP Rail. Now, as you can see, there's various information. It can be a little confusing, but I'm going to walk you through each of these infographics or stats of data. So the market cap is roughly 91.32 billion Canadian dollars. It's in the railroad industry. Earnings per share of $3.28. Price to earnings ratio roughly 21.87 on the last 12 months. And when you look at it on a forward price to earnings, roughly the same at roughly 21.80. So again, not a super low price to earnings ratio at all, but relatively average for what it's been trading at over the past couple of years. Now the dividend and dividend yield pays about a 56-cent dividend, which represents a 0.77% dividend yield. So if you're an income investor and you need a lot of current income, this probably isn't the right company for you. But if you're a dividend growth investor, and you have a long-term time horizon, this dividend yield will compound and grow over time. When we look at that free cash flow payout ratio or the payout ratio, again, 32% is a lot of room to grow that dividend. And we'll be looking at each of these as we go through the tabs here. So that is CP Rail and their key data metrics. Let's go and look at the financials. All right, so let's look at their total revenue. So again, yearly, as we can see here from 2006 or all the way till 2023, 2022. And if we want to spread this out, we can actually spread this out more. So we can see that revenue has been increasing steadily over the past 20-ish years. So over this 20-year timeline, it has increased. Now, again, this isn't a huge increase of revenue. Railroads are kind of more stable businesses and they are a little cyclical. If goods are not being shipped as much, they do tend to have dips in revenue. But again, steady revenue growth over the past 20 years. It's not exceptional, but it is growing over time. Now, revenue is not the end all and be all. We always want to see that revenue translate into net income or earnings. And when we look at that over the 20-year period, we can see that it's been great. You know, net income has picked up again from 2003 to 2012. It was relatively staying in that under $1 billion. But again, we can see that it has accelerated significantly over the past 10 years. And I expect it to continue after this merger. So let's look at their shares outstanding. Again, railways, like I said, they employ leverage. They like to buy back a lot of shares. And as you can see here, it was relatively the same share count up until roughly 2014, where they started aggressively buying back shares. So that was very nice to see. They were making us larger owners of the business. But then right after that merger deal, they actually had to dilute us as shareholders to get that KCS acquisition. Again, that was a combination of share issuances and debt, or specifically cash that they paid for this deal. But in my opinion, it's going to be accretive for the long-term future of this company. So I'm actually okay with issuing some form of shares here and then also paying out some cash. That was actually a good mix in my opinion. Now, we should look at the diluted earnings per share. And again, as we expect, they have increased significantly over the past 20 years. But then again, we had that dip as the earnings per share or those shares increased after that KCS deal. All right, so let's scroll up and let's go and look at the dividends. All right, so we can see the dividend yield, like I said, is 0.77. Nothing to write home about if you need current income, but they are growing these dividends significantly. We can see that over the past 5 years, the compound annual dividend growth rate has been roughly 7.89%. So a very, very nice dividend growth rate here. And we looked at payout ratio and the free cash flow payout ratio. So the payout ratio is based on net income, so it's a little less relevant. It is very, very low at 16.87%. The free cash flow payout ratio here, this is more relevant. Companies pay out dividends with their free cash flow. So it's at 32%. So nice, low free cash flow payout ratio here in terms of the dividend. A lot of room to grow that dividend over time. Let's go and look at the annual returns. So if we look at CP Rail over this, past 22-ish or 23-ish year time period, you can see the S&P 500 here in the dark gray, and then CP Rail here in the light blue for the total returns. And if you want to look at the price returns, those would be in the light gray and the green. But we're going to be looking at the total return. So as you can see here, over this past period, CP has actually had a total return of roughly 1900% compared to the S&P 500, which is roughly 357%. So handily beating the S&P 500 over the past 20 years. Great returns here for CP Rail holders. Now let's look at the dividends. So the dividends have been increasing over time, just great steady dividend growth for CP Rail. And again, you can look at that in terms of a yield on cost here as well. So I want to look at their future. So what have they communicated to investors in terms of their future? So the outlook for long-term growth here from 2024 to 2028, they have high single-digit revenue growth. So again, when I'm thinking of high single-digit revenue growth, I'm thinking in terms of 7 to 9% here in terms of revenue growth. I feel like that's a reasonable assumption. Now, double-digit core adjusted earnings per share growth. So again, double-digit adjusted earnings per share growth. Again, here I'm thinking this is because of a combination of their earnings increasing and buying back some shares. I would think that, the double digit could be anywhere from 10 to 12 or 13%. So kind of in that lower double digit range here in terms of earnings per share growth. Again, like we saw, they said they're going to have capital expenditures being roughly the same of roughly 2.6 to 2.8 billion per year. So kind of probably around that 2.7 billion per year is what they'll continue to spend. So they have great foresight into what they're going to be spending in terms of capital expenditures. And their adjusted combined free cash flow conversion of core adjusted combined income, roughly 90%. So that's a great ratio here in terms of combined free cash flow. And again, when they state combined, they're speaking to CPKC as opposed to the previous just CP. Return to double-digit core adjusted combined return on invested capital. So again, focusing on that return on their invested capital or the dollars that they invest. And again, I'm thinking 10+%, probably in that 12 to 13%, pretty analogous to that EPS growth. I think it'll probably come in fairly close to that. They have strong margin improvement through cost control and operating leverage. So again, focusing on the safety, on the efficiency, on their margins, and still putting a certain point of leverage into the company in terms of operating leverage. But I'm very bullish here on the long-term growth of CP Rail, and that's why I've been adding to it for the past couple of months. Now let's go and see what you could have earned if you had CP Rail. We did kind of look at it in terms of a percentage, but let's look at it as a dollar amount. So if you had $10,000 and you invested into CP Rail 20 years ago, that would have grown right here in the black line to roughly $145,000. Now comparing that same $10,000 invested to the S&P 500 over that same time period here in blue, you would have actually earned $50,000. So a pretty significant difference here of roughly $100,000. And that's just on the price return, not on the dividends. So when you look at the S&P 500, it was roughly an 8.4%, so that's the average for the S&P 500 over a long time period. When you look at CP Rail, it had 14.3% per year over that past 20-year period. So a huge margin of outperformance here by CP Rail. Now, when we look at it with dividends reinvested or the total return, the more relevant metric here, we can see that you would have actually made 173 or not made, you would have gained $173,000 here if you held CP Rail over this 20-year period, which would have represented 15.33% per year return. So a huge return here compared to the S&P 500, roughly 9.57% per year over the past 20 years. Still a great return, but it's still very lagging behind CP Rail. Again, CP Rail, the margin of outperformance here has been very great. So I think that CP Rail, again, is a great holding. I hold a couple of the class 1 railroads in my portfolio. I have CP Rail, I have UNP, I have CN or CNI, I have NSC. I think they're all great businesses, but in terms of growth, I think CP Rail is going to be one of the great growers or great returns here, in my opinion, for my specific YouTube dividend growth portfolio. Now, if you have any comments or any thoughts, please share them in the comment section below, and I will do my best to answer them. Do you like CP Rail? Do you not? Do you hold any of these railroad companies? Just let me know. If you have any other questions or any other comments, I encourage you to leave them in the comment section as well. So that's the video, and I'll see you in the next one. Have a great day. Bye. Please note, I am not a financial advisor by any means. All this content is made merely for your entertainment and educational purposes only. Please do your own due diligence when investing. Investing is inherently risky and you may lose money. I am not responsible for any investing decisions or losses you may incur. Thank you. Have a great day. Bye.